$91 is not a number you trade. It's a signal flare. Markets want you to believe prices are destinations, tidy mathematical conclusions where buyers and sellers politely agree. Silver doesn't work like that when stress enters the system. At moments like this, price stops being a valuation mechanism and becomes a diagnostic tool, and $91 is flashing red. At this level, silver is no longer responding to sentiment, news, or speculation. It's responding to structural strain, the kind that forms when leverage piles on leverage, when paper claims multiply faster than physical inventory, and when everyone assumes liquidity will always be there, until suddenly it isn't. That's what $91 represents, the moment the paper market realizes it may not be able to perform. For years, silver has been boxed in by derivatives, futures contracts, options, swaps, a towering synthetic supply designed to keep volatility contained. Every rally was capped, every spike faded, every breakout sold into submission. Not because silver wasn't scarce, but because promises were plentiful. At $91, that model starts to crack. Why? Because above this zone, hedging stops being theoretical. It becomes urgent. Short positions that once felt safe, protected by margin rules, rolling contracts, and assumed liquidity, start to behave like live explosives. A $1 move isn't noise anymore. It's margin impact. A $5 move is a liquidity event. A $10 move is existential. This is where sellers don't sell because they want to. They sell because they must. And when forced sellers meet a market with thinning physical backing, the result isn't balance. It's dislocation. That's why $91 isn't resistance. Resistance implies control, lies. This is closer to containment failure. Above this level, the illusion that silver can be infinitely rehypothecated begins to dissolve. The same ounce cannot be promised 10 times when delivery risk is questioned. Suddenly, counterparties care who they're exposed to, clearinghouses care when contracts settle. And traders stop asking, what's the price? And start asking, will this clear? That's the psychological shift, and once it happens, it doesn't reverse cleanly. The most dangerous assumption in the silver market has always been that volatility can be engineered away. That paper volume can overpower physical reality indefinitely. $91 tells us that assumption is wobbling, because when price accelerates through a level instead of stalling at it, it means the market didn't have time to prepare. Stops get skipped. Liquidity gaps appear. Algorithms pull orders. What looks like strength on a chart is actually absence of sellers. And absence is far more powerful than demand. At $91, silver isn't being bid up by optimism. It's being marked higher because no one wants to be the one caught short when the next settlement window opens. This is defensive repricing. Survival repricing. The kind that happens quietly at first, then all at once. Historically, moments like this don't resolve sideways. They resolve violently. Either the system reasserts control with overwhelming force, margin hikes, trading halts, coordinated suppression, or price escapes into a zone where paper can no longer follow without exposing itself. That's why this level matters. Not because $91 is expensive, but because above it, silver starts behaving less like a commodity and more like a stress asset. A mirror reflecting confidence loss in the broader financial structure. When silver ignores narratives and moves anyway, it's telling you something broke before the headlines arrived. $91 is that message. It's not asking for attention. It's warning those who understand the language. And the ones who ignore it usually learn the hard way, not from price charts, but from failed expectations. Before we continue, if you're getting value from this video, make sure to hit the subscribe button and turn on notifications so you don't miss upcoming updates. And drop a comment below. What time is it where you are right now? And where are you watching from? I love seeing how global this community is. Leave your location and local time, and I'll catch you in the next one. They called it a recovery. 48 hours, $6 trillion. Markets vertical, fear erased, headlines reset, but nothing was healed. What you witnessed was not a rebound in confidence. It was a liquidity flash, the financial equivalent of a defibrillator shock. Enough voltage to restart the heartbeat, not enough to cure the disease, and silver recognized it instantly. Real recoveries are slow. They digest losses. They redistribute capital. They allow bad debt to die. This did none of that. Instead, the system did what it always does when faced with collapse risk. It flooded itself. Liquidity was forced into the bloodstream at maximum speed through balance sheet expansion, emergency facilities, repo backstops, and silent guarantees. Not to grow the economy, but to prevent chain reactions. Because in modern markets, it's not losses that kill systems, it's timing mismatches. The 6T didn't arrive because investors suddenly believed again. It arrived because someone, somewhere, was about to fail right now. That's why the move felt unnatural. Asset prices didn't climb, they snapped. Correlations broke. Volatility collapsed before fundamentals could even catch up. When price outruns explanation, it's usually because explanation isn't driving the move. Liquidity is. Here's the key detail most people miss. Emergency liquidity is not neutral. It doesn't spread evenly. It goes where the pipes are already connected. Primary dealers, large institutions, leveraged funds. And when that money hits a system already saturated with paper claims, it doesn't create stability. It exposes fragility. Silver sits directly in that fracture zone. When liquidity surges this fast, paper metals absorb it first. Futures spike, options reprice, spreads blow out. But physical supply doesn't magically increase. Mines don't accelerate in 48 hours. Refiners don't double output. Vaults don't restock overnight. So what happens? Price has to do the work of rationing. Silver doesn't rise because it's loved. It rises because it's needed. And during liquidity flashes, what's needed most is collateral that doesn't evaporate under leverage stress. Cash loses value. Bonds wobble. Equities inflate. But metals, especially silver, expose the mismatch between claims and reality. That's why this 6T recovery didn't calm silver. It agitated it. Because liquidity injections signal one thing above all else. Authorities are afraid of time, afraid of cascading defaults, afraid that if markets are allowed to clear naturally, the damage will spread faster than they can contain it. So they buy time. But time purchased with liquidity is borrowed at compounding cost. Every injection raises the floor for hard assets. Every rescue narrows the exit for paper promises. And every time the system chooses reflation over resolution, it teaches the market the same lesson. Real things matter more than claims on things. Silver's reaction is not speculation, it's translation. It's translating monetary panic into price. The reason this matters is because liquidity flashes don't unwind cleanly. You don't drain $6 without consequences. You don't reverse emergency measures without exposing who depended on them. Once markets learn that intervention is instant and massive, risk perception changes permanently. Participants stop asking, "Is this sustainable?" They ask, "How long until the next injection?" That mindset is poison for currency credibility, and silver thrives in that poison. This is why calling it a recovery is dangerous. Recoveries rebuild trust. Liquidity flashes burn it. They keep systems alive while hollowing them out, turning markets into reflexive machines addicted to stimulus. Silver senses that addiction. It doesn't celebrate liquidity. It prices the cost of it. And when silver moves during a so-called recovery, it's telling you the truth the headlines can't. The system didn't get stronger. It just got louder. $6 trillion didn't fix the problem. It confirmed it. When China isn't buying a silver move, that alone is a message. For decades, the East has been the quiet absorber of Western excess. When paper markets convulse, when prices are smashed or distorted, physical metal usually flows east, through Shanghai, through Hong Kong, through private channels that never make headlines. That flow is the release valve. It's how stress dissipates. This time, the valve didn't open. China wasn't stepping into arbitrage. It wasn't bidding aggressively into weakness. And it wasn't setting the tone through premiums. That absence matters more than any headline rally because it tells us this move didn't originate from physical demand in Asia. It originated from restriction. When Shanghai premiums decouple instead of spike, it means metal isn't unavailable because of price. It's unavailable because of access. Logistics freeze, export approvals slow. Inventory is held back. Metal is redirected before it ever reaches the open market. What looks like no demand is often no permission. Being locked out doesn't mean China doesn't want silver. It means silver didn't make it to the point where China could express that desire. That flips the usual narrative on its head. Instead of Eastern demand pulling prices higher, Western paper stress pushed price up without the stabilizing force of Asian physical buying. No sponge, no absorber, just price reacting to imbalance. That's dangerous. Because when the East is absent, price discovery becomes fragile. Western markets are dominated by leverage, algorithms, and short-term risk management. They move fast, but they don't anchor. Without physical arbitrage from China smoothing volatility, moves stretch further and snap harder. This is how gaps form. And when China is locked out, it also means something else. Metal is being strategically withheld, not sold into rallies, not released to calm markets, but conserved, either by producers, refiners, or sovereign interests who understand what comes next. Historically, China doesn't chase spikes. It waits for dislocations. It buys when others are forced to sell. So if it missed this window, it's not because it misread the market, it's because the window closed before it opened. That suggests urgency upstream. Someone chose to keep silver off the market during a moment of stress. That's not normal behavior in a healthy system. Healthy systems sell into strength. Stressed systems hoard. When China eventually re-enters, and it always does, it won't be to chase price. It will be to secure supply. And when that happens, price won't need momentum. It will already be gone. China being locked out isn't a footnote. It's proof this move wasn't demand-led. It was containment-led. And containment always fails eventually. Markets love targets because targets imply control. Round numbers feel safe. They suggest symmetry, planning, intention. But in stressed markets, round numbers don't act like ceilings. They act like voids. Empty spaces where liquidity thins out and price accelerates because there's nothing solid left to trade against. That's what $100 is for silver. Not a goalpost, a vacuum. Below $100, sellers still believe in order. They trust hedges, they trust liquidity, they trust that someone else will always take the other side. But as price approaches a psychologically explosive level, behavior changes fast, offers disappear. Not because sellers are bullish, but because they're uncertain. And uncertainty removes liquidity. No one wants to be the seller remembered as the one who sold just before discovery broke. So instead of stepping in, participants step back. They widen spreads, they reduce size, they wait. That waiting is what creates the vacuum. Once price enters that zone, it doesn't grind, it jumps. This is why asking whether silver can hit $100 in 24 hours misses the point. Time frames stop mattering when liquidity collapses. Moves compress. What took months can happen in hours because the market isn't negotiating, it's searching. Searching for real sellers, searching for physical offers, searching for anyone willing to commit inventory. And if it doesn't find them, price keeps climbing until it does. At $100, silver stops being a trade and starts being a stress referendum. Shorts reassess survival. Producers reassess forward sales. Clearing members reassess exposure. The question shifts from is this overbought to what happens if this doesn't stop? That's when price becomes reflexive. Higher prices create more risk, more margin calls, more forced decisions. Each one removes liquidity from the book. Each removal makes the next move faster. This is how verticals form. Historically, vacuum levels don't resolve cleanly. They overshoot, because once the market realizes it mispriced risk for too long, it corrects not to fair value, but to safety premium. And safety premiums are always exaggerated in the moment. $100 is simply the line where silver stops being ignored. Above it, the metal isn't competing with stocks or bonds, it's competing with confidence. Confidence in pricing models, confidence in paper settlement, confidence that delivery won't matter. If that confidence cracks, price won't pause to ask permission. So no, $100 isn't the end of the move. It's where the market finally admits it doesn't know what silver is worth anymore. And when markets admit ignorance, they don't drift, they lunge. When gold is calm during a silver surge, most people assume the move is speculative. That assumption is backwards. Gold doesn't rush. It doesn't flinch at every liquidity tremor. Gold waits for confirmation, not from charts, but from confidence failure. Silver, on the other hand, reacts to stress in the plumbing. It feels pressure where systems are weakest. Leverage, collateral, settlement. Right now, silver is screaming. Gold is observing. That dynamic matters. In true monetary resets, silver moves first because it sits at the intersection of money and industry. It's used, consumed, rehypothecated, and promised far beyond its physical availability. When systems strain, silver exposes it early. Gold only moves when that strain spreads from mechanics into psychology. So gold's composure isn't dismissal, it's assessment. The gold to silver ratio tells the story quietly but relentlessly. Ratios don't snap without cause. When the ratio compresses violently, it's not silver catching up. It's silver dragging gold toward reality. Historically, gold doesn't lead these phases because gold doesn't need to. Its market is smaller, tighter, more sovereign. Central banks already understand gold's role. They don't panic buy it. They accumulate it slowly, deliberately, in silence. Silver doesn't get that courtesy. Silver is left in the open market, abused by leverage, and dismissed as industrial. That's why when stress hits, silver reprices first. It's the canary that survives long enough to scream. When gold finally moves, it's never because silver told it to. It's because silver proved something broke. And when that proof becomes undeniable, gold re-rates not as a commodity, but as trust insurance. That's the moment portfolios change. Right now, gold is watching the spread behavior, watching delivery times, watching whether silver volatility collapses or compounds. If silver stabilizes, gold stays patient. If silver accelerates while paper structures strain, gold doesn't chase. It steps higher in steps, repricing confidence itself. This is why gold's silence is dangerous for paper markets. It means there's no panic yet, no emotional buying, no headlines screaming safe haven, just mechanics grinding, and mechanical failures always precede psychological ones. Silver is breaking the surface tension, gold is waiting for the rupture. When gold finally joins the move, it won't validate silver's rally. It will validate the reason for it, and by then, silver won't be leading anymore. It will have already done its job. Every silver crisis eventually reduces to the same confrontation. Not price versus price, not bull versus bear, but metal versus promise. For years, the silver market has functioned on an unspoken agreement. Most participants never intend to take delivery. Contracts roll, positions net out. Paper volume dwarfs physical supply because everyone assumes settlement will always be optional. That assumption is the foundation of the paper market, and it only works as long as nobody questions it. What we're seeing now is not enthusiasm, it's doubt. Doubt about inventories, doubt about sourcing, doubt about whether paper claims still map cleanly onto real metal in vaults that can actually be accessed. When doubt enters, behavior changes instantly. Participants who once treated contracts as abstract exposure start treating them as potential obligations. Clearing members reassess counterparty risk. Large holders quietly ask uncomfortable questions about delivery timelines, locations, and substitution clauses. This is the phase where the system stops advertising confidence and starts testing it. Physical silver doesn't need buyers to rise in price. It only needs sellers to hesitate. And right now, sellers are hesitating because releasing metal into a stressed system is irreversible. Once it's gone, and replacing it later may be impossible without paying up. Paper can be created infinitely. Physical cannot. That asymmetry is the endgame. As stress builds, the gap between the two widens. Paper markets attempt to suppress volatility with size, with roll incentives, with rule changes. Physical markets respond by tightening, by lengthening delivery, by quoting on request instead of firm offers. Those are warning signs. This is how markets transition from pricing abundance to pricing availability. And availability is binary. Either metal is there or it isn't. When that line is crossed, price stops being a function of supply and demand and becomes a function of credibility. Whose promise is believed? Whose warehouse receipt is trusted? Which jurisdiction matters? That's when paper markets lose their advantage, because paper relies on trust at scale. Physical relies on possession. In calm times, trust is cheaper. In stressed times, possession wins. The endgame isn't a crash. It isn't a squeeze headline. It's something quieter and more dangerous. Segmentation. 2 prices, 2 markets, one for claims, one for metal. At that point, charts become irrelevant. Arbitrage breaks, and those holding paper discover too late that liquidity only exists until it's needed most. Silver doesn't announce this transition. It reveals it. And once the market starts asking how much silver is left instead of what silver is worth, the game is already over. Not with noise, but with finality. This isn't a silver story. It's a system story that silver is forced to tell. Every move you've just witnessed, the speed, the gaps, the silence from the usual stabilizers, points to the same conclusion. The market is no longer confident in its own machinery. Price isn't discovering value anymore. It's discovering weakness. When trust erodes, metals don't rise because they are loved. They rise because they are indifferent to promises. Silver doesn't care about narratives, models, or reassurances. It only responds to pressure, and pressure is everywhere now. What happens next won't be decided by headlines or targets. It will be decided by delivery windows, by who can source metal without asking permission, and by who finds out too late that liquidity was conditional. This is the phase where observers become participants, where paper comfort gives way to physical reality, where silence matters more than price. Silver is not forecasting the future, it's reporting the present. And the present is telling you one thing clearly: the system is blinking.